going live. Actually, driving to Shimon's house. We're gonna have an afternoon and a beautiful Sunday together. I'm in my car. My kids' car seats in the back. But for those that are gonna see this on the podcast later on, or on the video on the YouTube channel, or on Defiance Media on Sling TV, a lot of our channels. I just wanted to talk a little bit about the Sunday, about the markets. The markets, and what does it feel? Well, how does it feel to actually be in the markets now? And look, it's not fun. I just want to talk about a couple of things. It's obviously been brutal. The markets are crashing. It's never easy. So maybe one is just a piece of humanity. Shimon and I talk a lot about what our investment strategy is, what we should do, where we should invest, and how. And look, it's painful too. It's painful for us. It's stressful for me. I have a certain amount of wealth in crypto, a certain amount of wealth in stocks. I, I do believe in high growth stocks. That's been our thesis all along. And there's pressure. We manage our money, we manage our family's money in many ways. We manage other people's money. We have funds. And so it's not easy. It's not easy. It's painful. And a lot of analysts talk about how many young people, including us, have never been in a situation with high inflation, a situation with, very high interest rates, a situation that doesn't involve a bull run in bonds, which we talked about in the last episode. But if for those of you who may have missed it or aren't listening or haven't listened, excuse me, uh, basically a bull market in bonds means that somebody, government, us, more recently the government is buying bonds. When you buy bonds and the bonds have a certain amount of coupon, so $100 bond returns 2%, the coupon is, call it $102 at the end of the year, right? And the bond goes on the secondary market. Well, if you buy that $100 bond for more than 100 because you think it's very valuable, the price goes up to 101. The yield on the bond from 101 to 102 is a lot lower than from 100 to 102, right? So the yield falls as the bonds increase. So we've had 0% interest rate. We are at very low yields on bonds for a decade plus, if not more. Actually, I think in bonds it's been 20 years or so. But they've been falling over time, and people are now worried about a reverse environment, right, where the Fed is now going to be hawkish on inflation and so on. So when you have an inverse environment and yields go up, which means people aren't buying bonds anymore, it's a bear market in bonds, it's a bear market in stocks, it's a very risk-off environment. People are literally hoarding cash. Um, so up until a little bit ago, everyone was saying, including us, and by the way, I still believe it, you should be fully invested, fully invested. Now people are in cash. People sold off a lot. And when individuals, especially in the US, sell off, you sell things, you get a tax event. When pensions do this, major money movements, it's not taxable. So they can move in and out of positions short term. They can say, you know what? I think energy is going to hit or financials are going to hit. We're going to move out of crypto or high growth and move into energy. So Uber point number one, it's painful. And, just wanted to acknowledge a human aspect of it. It's very hard to look at my portfolio day in, day out. And sometimes I look at these companies, it's a very technical market. I look at these companies like Microsoft. I used to work at Microsoft, and I've become a very big believer of Microsoft because I've seen what it's like on the inside. And for all the imperfections it has very deep moats, very deep entrenchments within enterprise. And so I don't think that's going away. And in Microsoft's case, they beat earnings, they guided up, and they're getting shellacked in the market. It doesn't make any sense. It's a very technically driven, bot driven market. I think it's a very thin market where a sell order really moves down the price, but a lot of money is sitting on the sidelines waiting to get in. I listened to an interview with, I forgot, a gentleman from BlackRock talking about how they're holding money with two hands right now. They're just holding cash and they're waiting and they're being patient. They're waiting and they're waiting and they're waiting. So it's painful. I think the second part is I'm a little bit overextended, but I'm eyeing the ARK innovation stocks, Kathy Woods, they've been beaten down so hard. I think very much oversold, just like everything in tech, especially in growth tech, is that I believe that it might be a buying opportunity in the next month to really get into ARC. We're going to see a bottom soon. I mean, we're so oversold in these stocks. It's getting to the point where Facebook is has lower, you know, multiples than like a Sam's Club or Target. It doesn't make any sense. So at some point, we're gonna have to start getting back into tech, and you should probably think about starting getting back into tech now, slowly. Don't do what I do, what I just jump in, um, but maybe slowly, right? Start dollar cost averaging into tech. And so I'm starting to eye Kathy Woods' ARK innovation, especially the ARK-K, the flagship fund. I see it as a little bit more diversified, genomics and so on. And actually, I wanted to make a video about this. It's kind of the next point is why. Why do I think we should dive in and get in? Um, I think that Kathy talked about it a day ago, but if you think about any tragedy that we've had in throughout humanity, ultimately it causes after the tragedy is over, we do a post-mortem, a collective global post-mortem, and say, okay, what can we do differently? And I think one of the biggest things from COVID is mRNA technology and a new spawn of innovation in pharma. I think from Ukraine, Russia, there's going to be an innovation in weapon technology, right? So in defense, so defense would be a great industry to get into, U.S. defense especially, renewables, but also I think food, genomics, GMOs. What we're seeing now is by Russia holding the ports of Ukraine, and also Ukraine not being able to holding it's Europe's breadbasket, if you will. There's so much grain that Ukraine holds for Europe, but also for Africa, and Africa is very much acutely uh, uh, affected by this because they are well. There's a lot. There's a lot with Africa. They are dependent on Ukraine's grain, and I believe, and I hope I'm very wrong, that there's going to be a famine, a coastal famine in some African countries. And if that's the case, we're going to have millions of people starving, right? Millions of women and children. And that's terrible, terrible. And so what I think is going to happen is we're going to start quickly, just like we're this was a spawn for NATO countries to pay more for defense. It was a catalyst for uh, Europe to get off of Russian gas. It's going to be a catalyst for renewable energy, and it's going to be a catalyst for food technology, ag tech. So if we're seeing any new startup in ag tech, especially one that has the ability to grow modified and safe organisms in various areas, like let's call it Africa, which is more arid um, than not, or in a more compact less soil intensive way, man, if I had extra cash, I would dive in. Again, 5 to 10 year horizon. These things take time. It takes a year or two just to catch, another couple of years to perfect, right? But if you're thinking long term, thinking for retirement, putting 10,000 in here and there, placing some chips on the table, putting 1,000, doesn't matter. Putting anything that you can afford to for the long term, I think is going to be a genius play. So that's kind of where I'm thinking of putting money in. I'm being a little bit more cautious now. I'm working to build up cash. I'm saving and living a little bit more frugally. So even the effects of the interest rate hikes and stock declines uh, are going to affect. And I'm hoping, although I think I'm less optimistic than some of the other people in the market just because of the Ukraine war, I'm hoping that inflation starts coming down. If we see an April print, which is going to happen next week, that's lower than March, and then in May that's lower than April, that March was the peak. Man, oh man, I think we're going to start seeing a much less hawkish Fed, right? Again, data driven, but maybe another 50 basis point hike in June, and then they can lay off. And if we see some other supply chain changes, like what we talked about, people stocking up and having a lot of inventory, and ultimately inventory will put pricing pressure down on various goods, right? Because you're not able to sell them; they're sitting in inventory. People are, went crazy. They after COVID, they bought a whole bunch of goods, stocked up on goods. I feel like now people are just traveling, right? Especially in the U.S. and as the world opens up, people are just traveling. So services are getting a hit. Hopefully, they'll come down towards the fall. And then China. I mean, for God's sakes, China just needs to open up the country or allow Western vaccines to go in, vaccinate everyone, right? And then just at least live normally. China, President Xi's zero COVID policy, I think it's just a masquerade for being able to control the population. You're not going to get zero COVID. That'll never ever happen. There are articles about people in China are surprised they've been locked up for 2 weeks. How do they get COVID? It passes. It's very transmissible. You have the same air in an apartment building. This is ludicrous what they're trying to do. So as soon as China gets off of this bullshit and opens up supply chains the way they should be open, I think we'll start getting out of the woods. So, by the way, this is another impetus of why we should have. This goes against globalization. If you have countries that freak out like this because of COVID or, God forbid, some other much more deadly virus, then how can we rely? How can we have resilient supply chains of food, of products, of bleach, of Clorox, of various household use products if we just went through this stress test and we weren't able to get it? So anyway, some musings for the morning of Sunday morning. Hopefully, this is helpful, therapeutic. Maybe it was therapeutic for me, just to talk about it a little bit and to admit that I too am stressed. It's not an easy market, right? It's it's easy to talk about 5 to 10 year horizon. Much harder to do when it's your day to day and it's your dollars and it's your money, it's your family's money, it's your kids' money. But again, these are harsh lessons about being measured, not being too greedy, trying to control the emotions, control the FOMO. Don't invest more than you can withstand. Definitely don't have it affect your lifestyle, right? So, and then keep on keeping on. Again, Shimo and I talk a lot about big macro trends, but what helps me, right? What helps me is I look at my portfolio. Days like the last week has been down like 20% of my portfolio in the last week and a half, 2 weeks. Just brutal. But I look at the names and I say, do I believe in these names? Is this fair that these names are getting hammered? Microsoft, absolutely believe in the name, are doing better and better and better. Amazon, absolutely believe in the name. How Amazon, even if they missed, they're such a staple of our supply chain and logistics now. They're going to stay here for a while. Apple, I think enough said. I have Walmart. They're going to stay around for a while. Disney, okay, between the streaming and the parks and everything that Disney brings to the table, I believe in them. I had Netflix, and the sell off of Netflix now from the high of mid year last year or towards the end of last year to now erased all gains from 2017. Okay, I get it. Netflix is under pressure, lost some subscribers, but to say that Netflix today is as valuable as Netflix was in 2017 is a ludicrous statement. It's ludicrous, right? Like Netflix is no less, it's not less valuable in 2017. 2017, they barely had any originals. Anyway, I don't want to get, that's not the point about Netflix, but it's a point. Nvidia, I have in my portfolio. Nvidia, who is going to be the chip maker for all crypto mining in the future, and I believe in crypto, right? MicroStrategy, I have in my portfolio. No, look, that was a bit of of a gamble, and that's really hurting me. But again, in the long run, if Bitcoin does what it's going to do, and I believe that it will, MicroStrategy is going to go up. MicroStrategy is a good hold, even though short term has been brutal. I had Tesla. I sold out of it just because I was stopped out of it. But Tesla, I'm looking to get back into it. Really believe in Tesla. Um, Coinbase. I have Coinbase. Now, I made a mistake with Coinbase. True mistake. I bought, on the IPO on the day of. So I bought it like 386. It's at 100 now. I lost 75% of my investment in Coinbase. That hurts a lot, a lot, a lot, a lot, a lot, a lot. But if I believe in this industry, and I believe in the biggest, most regulated company out there, which is doing, I think, what's very genius. They're creating essentially crypto as a service platform for enterprises. You want payments? Here you go. You want custody? Here you go. Out of the box. It's genius. Once crypto takes a hold, they're gonna create the same entrenchment that Microsoft has created with enterprise. They'll do with crypto enterprise. I think I'm going to be a Coinbase holder for a very long time. Kind of like what Amazon did. They, went up, it went to 96, dropped to 3, and now they're 3,000 or 2,000, right? But oversold 2,000. So, are there any names that I want to? Alibaba, I have a little position in. The Chinese, Amazon. They're gonna, they have such scale. They're gonna stick around. So, I look at my portfolio and I say, are there any, positions here that are truly terrible? No, no, not from a company perspective. I don't have anything high growth. Moderna, I have Moderna that's high growth. That took a freaking hit. But again, I believe in the pipeline, right? That's probably that MicroStrategy and Coinbase are my most speculative bets that will take a while to culminate. But the rest,